Welcome everyone to today's live Q&A session for managing endowments in a crisis. Today's nonprofit experts are Dean, who continues to help various finance and audit committees who all appreciate his laser focus on bringing to life the audit items that matter the most, including his proven method of benchmarking data and key financial operating ratios. We have Stacy, who provides attestation services to nonprofit organizations in the education, environmental conservation, social services, healthcare, and in the religious space. Eric is joining us here today from Adler and Colvin. His areas of expertise include charitable gift planning, nonprofit organizations, donor advised funds, and endowments. Dave is here from BNY Mellon, who in his role there advises individuals, families, family offices, and nonprofits to reach their financial goals. And with that, I'll kick it over to our presenters.
Thank you so much. Thank you everyone for joining us. A quick overview about Armanino. Our goal and our purpose is to be the most innovative and entrepreneurial firm that makes a positive impact on our clients, people, and communities. And that definitely includes all of our nonprofits. Nonprofits is our largest sector at Armanino, and we're definitely happy to help you manage our current situation in this current work from home COVID crisis. Go ahead and go to the next slide, Marie. We know that right now it's imperative that nonprofits are really managing through four main areas. One being cash and cash controls, looking at government aid and access, including the PPP, managing their workforce, both currently and remotely, and lastly, looking at that internal and external communication and getting the most out of your stakeholders and your team. We do have a COVID-19 resource center. The nonprofit section is very, very long, especially because of experts like Stacy, who we have on today. And with that said, we'll get started. Please let us know what questions you have. We want this to be as interactive as possible. Go ahead and chat them in, and we will do our best to answer those as they come up. And with that said, here's our agenda, and we'll get started. Thank you so much.
Well, thanks, Dean, and hello, everybody. Thanks for attending the webinar. I'm Eric Dryberg again from Adler and Colvin, and just to set the stage so we all know what we're talking about, most of what we're going to be chatting about focuses on endowments, and it's important to understand, of course, the distinction between a true legal endowment and a board-designated quasi-endowment. A true endowment is, as noted, a fund that is not wholly expendable under the terms of the gift instrument. That is a contract, if you will, between the charity and the donor. The gift instrument is a written record, generally seen as a letter from the donor or the terms of a will or trust. But do note that if you solicit funds for an endowment, please give to our scholarship endowment, and people return money in response to that solicitation, that those funds are endowed. So I always tell my clients to be careful using the E word. A quasi-endowment is something the charity's board designates as endowment, and that's a unilateral decision and can be undone. So a lot of these hard spending rules don't apply to quasi-endowments. And it's always important to understand that funds can be held subject to an endowment, which is a spending restriction, a purpose restriction, or both. You have, fortunately, the auditing firms have done a great job over the past 10 years or so in getting charities to really dig into their various funds and get them reported correctly. Classic endowments are those that have been shown as permanently restricted, and they've done a great job in helping charities kind of sort out how that part of the financial statement looks. Since 2009, the governing law in California, and frankly almost every state in the union, addressing endowments is UPMIFA, the Uniform Prudent Management of Institutional Funds Act. It's in our probate code at section 18500 and following, and it's really the law of endowments, and addresses in great part how much a charity can spend from its endowment. But it also has a broader application. It has a prudent investor rule that applies to all funds endowed and not endowed. And it talks about releasing restrictions as well. And it is retroactive, so it covers all of your endowment funds, whether they were received before or after it was enacted. But it is the law governing endowments. And we can flip the slide. There you go. So one of the key issues in endowments and MIFA is how much we can spend. And as noted, a charity under MIFA may appropriate for expenditure so much of an endowment fund as the charity, meaning the board, determines is prudent, taking into account a series of factors. And the first two are really setting out the dilemma of endowments, because the charity is supposed to take into account preserving the fund and the purposes and needs of the charity. Well, that's the conflict, right? Because we all have purposes and needs we want to fund out of the endowment, and yet we're supposed to preserve it, which suggests we should be spending less, and that's the tension. Do realize that this is really a decision for the board to make prudently under the factors in the law, and looks to the total value of the endowment fund. So we're sort of moved away from trying to figure out what is cost and what is income and what is capital gains and dividends and all that kind of stuff. It really is a look at the value of the fund in total and decide what is prudent. And while the board must preserve or take into account preservation of the fund, that does not mean that it cannot spend into principal. That is not you must not spend the corpus of the fund, but rather in a long-term view, you must maintain the purchasing power of the fund over the long term. And the commentary under MIFA is clear that a charity can spend principal, it can spend from an endowment that is underwater, if you will, if the board determines it's prudent. It just places a lot of pressure on the board because they have to deal with this preservation issue when they decide to do so. I also want to note that this is a default rule. It applies to all of your endowed funds unless the language of the gift instrument is sufficiently specific to override it. And just an endowment fund that says spend the income, spend only interest and dividends, preserve the principal, none of that language is specific enough to override this fairly generous default statute. But you know, some gift instruments may be. Even with this kind of generous spending rule, what do we do now? And we've had a lot of clients contacting us because this COVID crisis has really placed a lot of stress on the nonprofit budgets. The endowment fund has dropped in value, so their distribution is dropping. Donations have dried up. If it's a program service focused charity like a museum, they have no program revenue at all, and yet they still have costs and they still have needs. And it is very difficult for them to really sort of how to do this. So one thing they have talked about is increasing spending. How much can we spend out of our endowment? And the issue here is, you have that general prudence standard, but also California says that appropriating more than 7% of the value of the fund averaged over the last 12 quarters is presumptively imprudent. Now that's a presumption. The board can overcome that, but they really need, you know, in a sense, they're a little bit guilty until they can prove themselves innocent. So they really need to pull together the facts and the evidence and the analysis of why spending more than 7% is prudent. Now, I think, you know, in today's environment, there's an argument that they could do so. They really are going to have to sort of push on the needs of the organization as being paramount and of the utmost importance these days. And yes, preservation might be a little bit more difficult, and it certainly does not help if the endowment has gone down in value. But so it's a tough balancing act, but I think with the right set of facts, a good understanding of the law and careful documentation, a board might be able to get themselves to a place where they feel comfortable spending more than 7%. But that is a board decision, and it is part of their fiduciary duty. So it does come with some liability risk that they need to understand. And hence we see, you know, the benefit of bringing in experts, be they investment, accounting, and law, to help them kind of understand what they're doing and really document it properly, because documentation is really key here. You know,
Eric, that actually brings up a good question. You know, when you talk about spending and you know, these are extraordinary times. We have to think through this, right? We got to put together our minds and really document, like you said. But when it comes to spending policies or purpose limits or restrictions, is there anybody who's really enforcing it?
Well, great question. Yeah, I mean, this is an issue really enforceable by the Attorney General, the California State Attorney General. It's not a tax issue, and frankly, I don't think the IRS really cares about it much. So you're not going to endanger your C3 status, but it is something the Attorney General takes real seriously because they're all about preserving donor intent.
Got
Not
it.
to
Okay,
mention
that's
sort of
very helpful.
the optics and the blowback you can get from donors. But yeah, primarily it's an AG issue. Thanks,
Well,
Steve.
well, speaking of, if we're going to bring up the Attorney General real quick, is it available to, write to the Attorney General or petition some kind of court to talk about restrictions? Is that something that nonprofits can do in these extraordinary times?
Yeah, as a matter of fact, there are some provisions in the law, which I'd love to get to in just a minute, on how to release restrictions. And yes, one can approach the Attorney General. And your better course of action, as we'll discover in a minute, is probably trying to talk to your donors. But if we could flip to the next slide, these spending limits have then sort of started charities to say, wow, if we can't really spend more out of our endowment, can we borrow from it? Is this an investment from the endowment fund to the operating budget? And we could call it an investment. And I think the short answer to that question is no. To have a valid contract, and a loan is a contract, you need two parties, and you only have one board of directors. And just think about what the promissory note would look like. We the board lend to ourselves, or maybe the endowment committee lends to the executive committee. It falls apart as a contract. So I don't think one can really borrow from your endowment. Charities often, included in my office as recently as last week, ask us, can we pledge our endowment as collateral? And, for example, you have an endowment fund for scholarships. Can you go to a bank, get a loan, pledge the endowment fund as collateral, and then spend the loan proceeds on keeping yourselves alive? And I think the real problem there is you have taken money which is restricted for purpose, and in my example, endowment. And if you default on the loan, the bank's going to come and take the endowment. And it's going to look very much at the end of the day, you had purpose endowed funds, which got at the end of the day spent on operations. And I think that's a violation of those restrictions. And certainly the Attorney General sees it that way. There's also a little bit of a practical problem, is that the lender is going to insist that the charity's legal counsel give them an opinion that it is valid collateral. And in the matter we had last week, we declined to do so because I really don't think that's the answer. But Dean, yeah, you're right. The real big point here is trying to get those restrictions released off of the funds. And clearly the easiest way is to get a hold of your donors, because a donor can, in writing with the charity, release or modify a restriction, be it purpose or endowment. So you can, if you can get a list of your big donors, and if they have a separate fund, it's clear they're the donor of that fund. If you have a general fund that's got multiple donors, but you can ascertain how much a couple of the donors, what their share of that big endowment is, go to them and ask them to unendow their gift and make it totally spendable. Ask them to release the purpose restriction so you can use it for general. I even think it's possible to ask them to grant you the power to borrow from it or use it as collateral. Well, I don't think that works absent donor consent. I think a donor could give you consent to do either one of those, because again, the law is intended to defend donor intent. And if the donor says, I will let you pledge it as collateral, and I realize there's a risk it might get called, I think you're okay. If that doesn't work, because as the law says, you need to get the consent of the donor, which is a little hard if they've passed away, for example, there is a process by which you can write the Attorney General. If the fund is over 20 years old and under $100,000, you can write them, tell them why the gift restrictions are not workable, and propose an alternative use. It's a 60-day notice. If they don't object, you can do it. If the fund is too large or not old enough to satisfy that test, then you're back to petitioning the court, which is not really workable these days because they just aren't even having court hearings. So you really end up, that's not such a usable option. But we have had a lot of charities start to go back to donors and try and get some of these endowment restrictions released. So with that brief introduction, if you will, to endowment spending and access through borrowing, I want to jump this over to Stacy, who's going to talk about governance issues.
Awesome. Thanks, Eric. And hello, everyone. We're glad that we can have some of your time today. I'm going to be going over in this part some board governance best practices related to endowments, but also some best practices overall in terms of board governance, you know, that we've kind of been hearing about, been thinking about, been talking to clients about since this COVID-19 and since the shelter in place started. So the first thing that I wanted to talk to you about is board governance related to endowments and sort of like the fiscal management and the donor relationship management piece of it. As board members of your organizations, or if you're management of your organization and you're needing help, you know, from your board members in terms of endowment management and even some of these things that Eric was talking about with respect to spending, you know, with respect to reach out to donors if you want to ask them to release purpose restrictions. Those are things that you're going to want to like have your board members involved in helping you out with. Some of your board members have probably also contributed to your endowment maybe, or they've got, you know, the relationships with your endowment donors because they've helped you to build that endowment through your campaigns or through other cultivation efforts. So definitely this is a time to leverage those relationships and their expertise to help you with some of these things that we've been talking about. You know, one of the things that Eric mentioned was the differences between like the donor endowment and a board designated endowment or building board designated reserves. Well, again, this is another area, you know, where boards of the organization can really help support management in the organization during this time. If a board member is able to give some additional unrestricted support, or if they're able to help you build your reserves at this time and to continue to cultivate relationships to build some of those unrestricted reserves, again, definitely those are all things that, you know, we want to hear that board members are helping with at this time. A couple of other things on this slide, so planned giving. You know, and unfortunately, and I even hate saying this, but unfortunately, you know, the impact of the COVID-19 on, you know, folks out there and maybe individuals who are older and have been thinking about, you know, giving part of their estate and planned giving and things like that. Again, this is now a time to be talking, you know, and thinking through these types of things and reaching out to donors for planned giving efforts. So that's another area to focus on and to think about. I know that many of you out there in your boards and management have already been, you know, in the process of discussing planned giving with various donors, and you do a great job of that, but again, not, you know, something to continue to think about and do during this time.
And Stacy, I just had a client present me with a really interesting thought here, which is an individual can loan funds to a charity up to $250,000 without any interest rate, and you avoid a bunch of imputed interest issues. But it's a great way to talk to somebody that wants to support you now, but isn't sure that they really can afford to give up the money forever. So you say, great, loan us $250,000, a 5-year loan, and let's sort out in 5 years. If we have the money to pay you back and you need it back, we will. And if you wish to forgive the note at that point, you get a contribution deduction at that point. But it's a way to get some money in the door from somebody that is just not quite sure they're ready to give it up totally. So that's my one thought on planned giving.
Yeah, thanks, Eric. And as many of you have also heard about, if we can just go back to that slide real quick, so there's new tax benefits, right, to individuals out there that came out under the CARES Act. So there's a couple of things that are related to individuals, number one, who take a standard deduction on their return. So they can donate up to a certain amount, $300 to their favorite charity, and that's an above the line deduction. Additionally, there's another benefit that came out. So these are for folks who itemize their deductions. And it's really, I think, targeted towards donors, the wealthy and the uber wealthy donors. So if they make a charitable contribution, it's basically deductible up to 100% of their adjusted gross income. So that limitation, there's basically no limitation on that like there has been in the past. So again, if you're, you're a board member, your management of your organization, talking to your board members about helping you out, this is a good incentive, a good benefit to talk with them about and have conversations. So we move on to the next slide. A few other things just regarding board responsibilities and effective board governance. I mean, again, this is kind of from the standpoint, not really related to the endowments, but just kind of with the environment that we're in right now. The first thing up there, emergency spending resolutions, that could potentially be related to the endowment if you're able to go ahead and get donor acceptance and donor approval to spend into the corpus or to spend an amount above what's determined to be prudent per the laws that Eric was talking about before. Another thing that's really important during this time is whether or not board members and the board itself are able to function with absent board members who have potentially been impacted by COVID-19 in some way, shape, or form. So maybe they're dealing, with their own family issues or work issues or things and can't really just, be part of the board in the way that they were in the past. If you don't have succession plans, not only for management at this time, but the board, I mean, this is a really good time to revisit succession planning, filling some of those empty slots, thinking about relationships that you've been cultivating all along to make sure that your board isn't impacted and the ability of your board to make decisions isn't impacted by what's going on.
Stacy, with regards to, board questions right now, what about how they can support management of the organization? Can we dive into that a little bit more?
Yeah, I mean, I think the best way that you can support as a board member, that you can support your organization is to really be in tune with your management team. You need to understand, the issues that they're facing as they work through this, whether it's endowment related, cash flow related, programming related, really being able to understand all of those things is going to help you, to help them make decisions about how the organization needs to pivot, or how management or employees maybe need to think about, doing their jobs a little bit differently in this environment to continue programming and all of those things. Cash flow is going to be super important though. Like as a board member, you should definitely understand cash flow, but even more so during this time. If your organization doesn't have, a few different models for cash flow, based on certain predictions of certain situations that you might be in, that's something you should support your management team on and help out with and understand.
Great. And Stacy, there was on the last slide, talking to endowment donors. You talked about having those conversations. Give us some advice on, if there are nonprofits out there that are thinking about repurposing restrictions or allowing additional spend, what are some best practices there?
Yeah, I mean, I think one of the best practices that I'm hearing from clients is just really being able to go to a donor, and any donor, endowment donor or purpose, restricted donor, and be able to tell them how this has specifically impacted the organization and how their dollars and how their support is going to go further with the way the organization is pivoting. Like, for example, I work with some nonprofit clients in the healthcare space, and they've been doing a lot to pivot into like the telehealth and kind of, environment, and where maybe like right before COVID-19, that was just something they were still talking about, but like now they're doing it, they're forced into doing it. And so they've also, had to change some other aspects of their operations in order to be able to do that. And if they need additional funding, or redirection, repurpose of funding to be able to support what they're doing now, or, to support virtual programs or things like that, they've got to be able to tell that story. It's kind of like a capital campaign almost. Like, you've got to be able to tell your story and tell the donor and have them understand why, their dollars are going to be making a difference and how they're going to make a difference.
You said capital campaign. That makes me think, are there actually nonprofits right now that are trying to raise endowment dollars, or are they kind of allocating those dollars to other things? Give us some insight there.
Yeah, I mean, I do think that there are nonprofits out there that are still trying to raise endowment dollars, but I think that, you know, for the most part, what I've been hearing is that they're trying to raise them in an unrestricted manner. So they might do some type of unrestricted fundraising effort, and they're building board designated reserves or board designated endowments internally with it. That kind of seems to be like a little bit of the wave of the future for some nonprofits, you know, even pre-COVID-19. But they're having to do that fundraising in different ways, right? They're having to do virtual fundraising efforts. You know, they're hosting, you know, auctions and things online, or like trying to find those new and inventive ways to reach out and keep the funding coming in. Yep. All right, so if we go on to the next slide, just a couple of the next two slides, I just kind of wanted to leave you with some ways that, you know, as a board member, based on your professional expertise, you know, what you can specifically do to support your organization. And again, all of you that are on this, this Zoom meeting, this webinar that are management, be thinking about like the professional expertise of your board members, you know, when we're talking through this too, because these are going to be good conversations for you to have with them to make sure that you're getting, you know, what you need from them. So, I mean, attorneys, we've got Eric on the line here. Attorneys are great with all the legal implications of everything that's going on, right, Eric?
Yeah, you bet, absolutely. We're great.
It's interesting. We get a ton of questions from our clients and constituents that are legal in nature, and it's interesting when they think of asking the accountant for those questions, but it's really like a legal thing that we need to steer them to folks like Eric for. So
yeah, a lot of people come to endowments and they really think of it strictly in terms of accounting, right? Oh, it's permanently restricted, and that means a bunch of things. And there are accounting standards on how you have to deal with that, which I as much as I love accountants, you know, at some point, ultimately it's a legal issue. The accounting is going to be a consequence of what the legal issue and the legal answer is. So we got to work together on that.
Yeah, well said. If you're a banker, I mean, if you're a board member and you're a banker and you're, you know, maybe the institution that you work for has been involved in the SBA and the PPP loan funding process, that is a great wealth of experience because you kind of know what's going on from the lending perspective to maybe answer some of those questions that your organization, management of your organization has. That PPP area and you know, the treatment of it, the forgiveness, those questions, you know, are continuing to come up, and, you know, we're still not seeing as much guidance, you know, maybe as we need to on what to do and how to advise folks. But, you know, if you're a banker, your board members are bankers, they're a good wealth of information for that. IT consultants, so these guys are important. They're the ones that help you work remotely, right? Making sure everybody's got a laptop, you've got security protocols in place. If you haven't already, I think we're finishing week 7 of the shelter in place. I mean, if you haven't adequately addressed privacy and security issues for your employees working from home, definitely get any of your board members who have experience with this to help you out with that. I mean, there's so many creative ways that the fraudsters are now attacking us, right, in this work at home environment through Zoom and, you know, other means. So it's, again, even more important to draw attention to that area. Investment advisors, we've got Dave here from BNY. They're going to help you understand the short-term and long-term implications and objectives of what you need your portfolio to do for you during this time and going forward. You know, some organizations, they may be thinking about, you know, pulling their portfolios, and I know a couple have, you know, thought about pulling their portfolios out of the market to, you know, hedge against all the declines that we were seeing and still are seeing. I mean, that might work for some organizations depending upon your objectives and your operations and all of that, but it also may, you know, harm you at the end. And I know that David's going to talk more about that in a little bit. So if we go on to the next slide, accountants were definitely important to help you with your cash flow analysis, those what if scenarios, financial modeling, all of that, all of these things that we've been talking about regarding endowment management and sort of the accounting piece of it and what you want to think about in conjunction with your attorney. And then also the regulatory and the compliance audit needs. Again, there's been a lot of questions that have come out about the PPP funding and, you know, whether or not it's going to have compliance issues and audits attached to it and all of that. So those are things that, you know, board members, if you've got that expertise to be in the know about and to make sure that management knows what might be coming. Insurance brokers, so coverage is obviously, you know, key and important during this time. You know, we've gotten questions about whether or not, you know, business continuity insurance covers, you know, some of the issues that have been going on in the COVID environment. So if you've got questions like that, again, and you've got expertise on your board, lend that expertise in those areas. And I would just, you know, to kind of conclude here, I would just say that like all board members, regardless of your profession, and we went over a few key professional expertise areas that are on boards, but, you know, no matter what your background is, even if you are an individual who's involved in fundraising or grant writing or, you know, program activities, your expertise in what you do is still going to be so impactful. So find the best way that you can help support management, talk to them and make sure that they understand your area of expertise. And then just, you know, kind of a thought here before I turn it over to David to talk about the investment management side of it is just to all board members, make sure you continue to understand cash flow impact. If you are not getting information from management or management is, you know, struggling with how to do the modeling and kind of, you know, the what if scenarios and the variables to think about, work together on that. I mean, definitely need to have a plan and need to know on a go forward basis, you know, how everything is going to continue to impact you. So with that, I'm going to turn it over to Dave to go through some investing thoughts.
Great. Thank you, Stacy, and thanks everybody for joining us on the call this afternoon. I apologize in advance if you hear any errant noises behind me because I've got 3 boys at home and my wife is actually teaching class down the hall too. So this first slide, if you take a look at it, these are some of the questions that we've been getting from our clients in this environment. And I have to say, out of these topics, the one that, you know, has garnered the most attention and has been most top of mind with our clients is, you know, the growth question. How are we going to emerge on the other side of this? Is it going to be a V-shaped, a U-shaped, a W-shaped, even a square root-shaped type of recovery, if you could envision that? I do have some slides to support the notion of why you want to stay the course and stay invested. That doesn't mean that you don't make course corrections along the way in response to opportunities that have presented themselves out in the market, but staying invested and staying the course, which obviously means not getting out of the market unless there's some reason, like Stacy mentioned, to do that. And then finally, with you know, Stacy and Eric having covered both the legal and the governance aspects, I'm not going to focus too much on the role of investment committee members, other than just to say that I think it's markets like these and times like these that cause investment committees, and rightly so, to re-examine their investment process and really decide and ask themselves, you know, how can we improve our decision-making process to make it more dynamic? So with that, if we could move on to the next slide here. Well, we can go one more. Hard to believe. It feels like a world away and an altogether different world, but believe it or not, back in February, the market was actually hitting all-time highs. In fact, from February 19th to March 23rd, we saw a drawdown in the market from peak to trough of 35%. You know, what made it so acute was shown here with these 2 graphs on this page. This is known as the volatility index, or the VIX, for the stock market, often referred to in our industry as the fear gauge. And it just shows how volatile markets were, especially in the stock market, which is the one that we pay attention to the most, obviously, and the media does as well. But it wasn't limited to the stock market. In fact, you can see even in the treasury market, you saw extreme bouts of volatility in what is the deepest and the largest capital market in the world. So as I move through these slides, what I'm going to talk about is not so much spend time on where we were, because I think it was pretty clear that we had this 35% drawdown, followed very quickly in quick succession by a rally off the bottom, that both of which were very much historical by certain measures, but rather looking forward, talk more about where we are today and where we're going, and most importantly, how we're positioning our clients' portfolios in that context. So if you can move to the next slide, Marie. I'll just show that, and I'm not going to spend a lot of time on this slide, but what again really made this drawdown or this pullback in the market so acute and so painful was the magnitude of the drawdown over such a short period of time. And really you have to go all the way back to 1987, if you might remember the stock market crash then and Black Monday, to see anything that even approximates the sell-off that we just went through. So we can move on to the next slide. So what changed? Well, first and foremost, it was the Fed stepping in really to provide a backstop to the markets. They did so with a twofold purpose. One, just to add some liquidity into the financial system, just to make sure the financial system was functioning properly, because there were signs that in certain parts of the financial markets it wasn't. So it was really to kind of lubricate the gears, as it were, if you want to use that metaphor. The second reason was to make sure that there was enough liquidity all throughout the financial system and enough money supply out there so that any liquidity issues that were out there didn't turn into solvency issues. And they were successful in doing both. And, you know, I hate to use the word or overuse the word unprecedented because it's been used so much to describe this, you know, this time that we're in. But it really was unprecedented in terms of, one, the magnitude of dollars that they brought to bear here in this situation, having learned some lessons from the 2008-2009 downturn, and two, how quickly and how rapidly they did so, having lowered interest rates in the period of a day and then over a period of successive days, launching all these programs that you see listed here that were billions and trillions of dollars. So with that, if we could go to the next slide. This is where I get to talk about the importance of staying invested. And in fact, what I would do is first direct your attention to the right side of the slide, where we list the 10 worst trading days over the last 20 years, basically from March of 2000, which was a memorable time for people in the markets, to March of 2020, and the 10 best trading days over that same 20-year period. And what you'll notice is that most often the worst trading days are quickly followed by some of the best trading days. Maybe a matter of weeks, and in some cases, as you can see on here, just like it was this past March, they're in a period of several days from one another. So the challenge of trying to time those markets on a short-term basis just makes it, you know, so challenging to get in and out on a short-term basis like that. Even more so, if you look at the graph in the lower left-hand corner there, you'll see that over that same 20-year period, had you missed 5 of those 10 best trading days, your returns over that period of time would have been cut in half. And you can see as you move farther to the right that if you missed the top 10 days, the returns were even lower. And finally, if you missed the top 15 days, which we don't show on this page, you would have actually had negative returns over that 20-year period. So again, emphasizing the importance of staying invested so that you don't miss those periods of high returns in the market. On the next slide, what holds true for that short term, you know, on a daily basis, like we just showed, is even more the case when you extend it out on a quarterly, multi-quarter quarter basis, and then even an annual basis. Here we show some of the worst declines in the S&P 500 and showed how the market did 1 quarter later, 2 quarters later subsequently, and we've got data to support multi-quarter and multi-year periods from there. In the first 30 to 60 days following a sell-off like we saw in March, what you typically see is what we're seeing now, where the market's bouncing around on a technical basis. It's testing levels of support, it's testing levels of resistance, and it's going through that bottoming process. As you look forward and look farther out, those returns start to improve. And again, over the longer period of time, there's data support that it's even more so the case in multiple years. Next slide, Marie. We can't forget that the market is a discounting mechanism. It's something that anticipates the future, and it might seem counterintuitive, and it certainly doesn't feel like that when, for instance, through the end of today, through the end of the month in April, the market's actually up 13%, which is the second best monthly return in history, second only to 1987, again, that same period of time. Yet we have headlines as far as economic reports related to unemployment and economic activity that are shocking. How large the impact that's come from COVID-19 and the impact on the economy. So what this chart shows is for every major recession that we've had in the post-World War II period, with each of those recessions save one, the market has bottomed on average 4 months before the end of the recession. So again, the market's already looking forward and perhaps could be doing that now with the returns we're seeing in the market, despite the depth of the impact we're seeing on the economy. If we can go to the next slide, Marie. So with this slide, we could actually spend a lot of time, and some of it's been touched on by Eric and Stacy as well. So without going through this slide, from top to bottom, what I'd say is we're in a period of time right now where there are some steps you can take both on a strategic level and a tactical level with regard to your endowment portfolio. On a strategic level, start by asking yourself, what are the purpose of these assets? What do they want them to do for us? Stacy mentioned, is it more to help with near-term spending, or is it to be there in the future to sustain the organization and the organization's mission? Stacy mentioned the importance of cash flow. One great exercise to go through right now is to map out what your cash needs are on the next 1 to 3 to 5 year basis, and then match up what your cash sources and uses might be. And from that, determine what portion of that's going to have to come from the portfolio, from the endowment. And with that in mind, knowing the gap that you have to make up, how should we allocate our portfolio accordingly? So that helps you set the asset allocation on an overall basis. And then you want to make sure that your spending policy and your investment policy are both aligned with that. There's a lot of portfolio analysis you can do during this period of time as well. One great thing about having gone through the sell-off that we did is you get to see how the portfolio performed. Are there risks in there that you didn't know about? Are there correlations, for instance, that might be across asset classes or even across different investments that you weren't aware of before? Could there be risks going forward, maybe with some credit or bonds that you own in the portfolio? So now's the time to do all that analysis. And while it's down on the bottom as well, and probably the smallest contributor here is the point of the pyramid, it's an opportunity to re-examine costs too, to see if there's a way where going forward at least, you could find ways to cut costs and cut fees, especially in what could be a low rate or environment in the bond market and a low return environment overall.
Dave, here, when you see that top of the pyramid, portfolio analysis, structural analysis, diversification, that makes people think, like, is there any other investment trends or opportunities that they should be looking at? Is there anything that your firm is researching for endowments and foundations today? What are some trends out there?
Yeah, so and under portfolio analysis, one thing that would be very helpful that we utilize are capital markets assumptions going forward, right? we can't predict the future. Prediction is just that. But we do have to make certain assumptions about asset classes returns that we expect in the next 10 years. So we continually update those, and that forms the basis for our analysis on the portfolios. We also have a tool to do risk audits, which help people determine how a portfolio might perform going forward in extreme circumstances where you have drawdowns. And then just generally, we're looking at trends going forward because there's going to be some differences, right, in the world as we come out of this. One is the impact of monetary and fiscal policy, as we've seen. What's that mean? For instance, with all this money that the Fed has put into the system and with the fiscal stimulus as well from the government, what's that mean for future returns? What's that mean for taxes, which isn't necessarily an issue as much for nonprofits? And what's the impact ultimately down the road on inflation? Right now, deflation is what we're most focused on, but all this could lead to higher inflation down the road. There's opportunities in distressed assets right now, and that's something we're looking at very closely. If you think about how battered the energy sector got over the past month or so, with kind of a double whammy, right, of a demand shock because of COVID-19 and also a supply shock with a price war that was going on globally with Russia and OPEC. And then finally, changes in behavior. And I think that's at multiple levels, right? Not only are individuals likely going to be behaving differently as consumers, but governments, like we mentioned, and even businesses as well. So these are some of the trends we're examining, at-home lifestyles. How do investment themes play into that, or changing supply chains for manufacturing businesses? That's another area as well. Is that helpful?
Very helpful, Dave. Thank you.
Okay, great. Marie, if we could move to the next slide. So the question is, where do we go from here? And I'm humble enough to know I'm not sure if we're going to go up or down from here. This could be a bear market rally, or it could be the beginning of a new bull market. Probably the question that we get most from people that's unanswerable is, was that the bottom? And I caution people that the bottom is not so much a discrete point in time. It's a process, and it's a period of time. We're in that period of time. We're going through that process right now. And unfortunately, it's only with the benefit of hindsight that we'll know where the bottom is, or where the bottom was at that point. These are some of the things that we're looking forward to as indicators and as kind of a dashboard as it relates to fundamentals, both with the economy and with the markets as well. And as you can see, it's a mixed bag. There are some green lights, some yellow lights, and red lights. And hopefully we'll see more red turn to yellow and more yellow turn to green going forward. But the importance of looking at these indicators is because it informs our view for the next slide. Marie, could you flip to the next slide? Which is how we're positioning our clients going forward. I mentioned that predictions are just that. The future is unknowable by definition. History can be a guide, and that's why I shared some of the historical data on some of the earlier slides. But at the end of the day, we're still required to make certain assumptions about the future, and that's what informs this positioning here. You'll notice first and foremost that we're what we call neutral in stocks or equities. Over the last couple of years, in fact, as we've seen very solid gains in the market, and as the economic cycle, we became late cycle, we'd already started to pare back our equity exposure for our clients and their portfolios. That's not getting out of the market. That doesn't mean getting out of the market. But with the returns we saw, especially even in 2019, we just gradually pared that back. One thing you'll notice within our equity allocation is that we did make a tactical decision to overweight US large cap domestic stocks. And that's for a variety of reasons. One, they're the industry leaders, they're the market leaders. Two, they tend to have more diversified businesses. Three, strongest balance sheets. Four, many of them pay dividends and pay growing dividends. And five, Many of them have access to capital markets in a way that their small cap or mid cap peers might not. You'll also see that we're underweight fixed income, in particular treasuries, with rates at absolute lows here where they are. It's hard to see how you're going to achieve very high total returns and income from fixed income instruments, and especially treasuries. That holds especially true for treasuries. Finally, we're slightly overweight what we call diversifiers. That's a broad category that could range everything from commodities to real estate, hedge fund strategies, and even private equity. Hedge funds are in there, the portfolio, for a few reasons. One is they tend to dampen, there are certain strategies at least that tend to dampen volatility, and that smooths out returns, ultimately leads to higher returns. And there's roles for private equity as well, that in what could be a low return environment here going forward, especially in fixed income, private equity oftentimes is added to the portfolio as a return driver. The other thing that alternative investments or diversifiers like this bring to the table is what we call uncorrelated returns, meaning when the market's zigging, these investments are zagging or zigging less than the market. So they're designed to be in there to be an offset to some of the volatility that you do see in the equity markets, the stock market. So with that, Dean, why don't I turn it back to you for Q&A?
Yeah, no, great. Thank you so much. I think that, Dave, with regards to, one more question here. With regards to accessibility to, capital and closing some gaps, did we have any insight there? I know that sometimes, investments are liquid and sometimes they're a little bit harder to be accessed. If somebody needed some more short-term dollars, is there anything that people can be doing towards that?
Yeah, so Eric mentioned one of them, which are loans. We've seen a lot of our nonprofit clients, of course, taking advantage or seeking to take advantage of the CARES Act and some of the loans that are available under the CARES Act. There are board members who can extend outright loans, like Eric had mentioned, if there's significant supporters of an organization, or you can find banks that might be willing to lend, provided there is a personal guarantee. So I have knowledge of one nonprofit where they went to a bank for a loan and the bank said, yeah, if you could find some people to personally guarantee it. It was a smaller loan, a smaller organization, but some of their supporters did step up to provide a personal guarantee. And one that's closer to us are portfolio lines of credit. With interest rates as low as they are, there might be a way to use your liquid securities, as you mentioned, the stocks and bonds that you own in a portfolio, as collateral for a loan. So that's certainly something to look into with your investment advisor and with your investment custodian.
That is very helpful, Dave. Thank you so much. With regards to, and then this will go to anyone on our panel, do we know of any endowments, or is anybody considering pausing their endowment draw or spending per the policy during an academic? Is anybody doing that?
Not my clients.
Yeah, I've really only seen it if they haven't been able to get the donor to like repurpose the spend or the restriction on it. But yeah, otherwise I haven't seen it. It's been more of the other way.
Great. Eric, you talked about this earlier, is with spending policy calculations and things of that nature. Question number 2 is, what are some alternate hybrid endowment calculations being used right now? Is there anything that people could be considering?
Yeah, that is a good kind of long-term question, because, we all kind of revert to the typical endowment spending rule of, well, we're going to spend 4% or 5% of the value of the fund averaged over the last 12 quarters. That kind of smooths things out a little bit. And, I do think that the fact that it is a generally accepted standard probably indicates it works pretty well for most people. There are alternative calculations that some larger institutions do that either try to smooth out more or a little bit more, or on the other hand, are more reflective of kind of recent economic financial returns. And I almost think, Dean, that's a great topic for another webinar, because in today's environment, those really aren't where people are going. Where people are going is, I need to spend as much as I can, and it's not alternative, it's not hybrid, it's, how many dollars can I get out of the endowment?
Very
Yeah,
fair.
I'll just add to that I find the same thing, that the general fallback is the static spending policy that I find most nonprofits use. We actually did a study a couple of years ago of more of a dynamic spending approach, where, I mean, this makes intuitive sense, right? You just spend less when the portfolio is down, and then in up years you can spend more. But we did a study on a $10 million portfolio, whereby, if the market declined in one year by more than 3%, you would cut back spending, your overall spending amount, not the percentage, but the overall spending amount, by 5%. And then in any other year, increase it by 2%. And what we found was, by using that dynamic spending strategy, you actually ended up on that $10 million at the end of, it was a period of 2001 to 2018 that was covered. You ended up with $1.6 million more, which amounted to about 80 basis points of improved performance over the year. So you can play with those numbers and play with those bounds and do some sensitivity analysis on it. But that's another
David,
method
I
I've
think,
seen.
yeah, and I think the real issue is, are you coming at this from an investment perspective, which is,
Right.
let's really base spending on investment returns. And if they go up, they go down, they go up, they bounce around. The problem my clients have with that is they're really coming at it from a program perspective. I got to fund the scholarships, and I need a steady, predictable amount of money to fund the scholarships. And if we have a great year, we got an increased distribution, that's great, but I can't deal with, we have one bad year and the distributions drop off. That's why they're really always pushing to get sort of the smoothest and least dynamic spend rate, because they're kind of, if they're program driven, they have a hard time dealing with the ups and downs.
Yeah, that's typically, like I said, that's what we find is the common default also with our clients.
Yeah.
Some kind of smooth formula over whether it's a 3-year period, a 5-year period, whatever.
Very helpful. We have numerous questions, and we kind of touched upon it earlier, but if people are going to go to their endowment donors, the people who have established these funds, either for endowment or purpose types of restriction, any best practice there that we want to give everyone?
Yeah, I'll just jump in briefly. Looking at question 3, I think the law is pretty clear. When it says the donor may consent, it means the donor. It does not mean the donor's heirs. It does not even, I think, mean the donor's spouse. So, if you've got a husband and a wife situation as donors, and husband passes away, I think the wife can obviously release the restrictions on her half of the gift. I'm not so sure she can release it on the husband's half. Embedded, and certainly the kids cannot. Embedded in this question is the idea that, well, I have a deceased donor, but there's no personal administrator left, or personal representative of the estate left. I don't know that the personal representative can release the donor restriction. I mean, it's embedded in the gift instrument or the bequest. The personal rep does not really have the power to release or modify the bequest terms. Now, they can if they apply, petition to the court and get the court to release the restrictions. But I think that consent provision, while it is super powerful, does require that you actually get a hold of the donor of those dollars.
Yeah, that is very helpful. Do see a question here, and we're running up against the time limit, but OCO, did we touch upon that at all?
OCO and OCIO.
Oh, OCIO. Sorry,
Yep.
The second I is a little important there.
Well, there's actually both, but OCIO is a trend that we've seen in the industry, in the investment industry now for years. It was a trend that was already in place before the last financial crisis. It only accelerated with that crisis, and I think will accelerate again with this crisis, where it's giving more discretion to the investment manager to manage the portfolio, taking less responsibility off the investment committee and the board to do the day-to-day management of the endowment. In fact, the investment committee could fulfill their fiduciary duty by going through the process of selecting a fiduciary to manage the portfolio and really give that investment committee more discretion on how to manage the portfolio. And there's reasons why that's been a trend, and it's because of situations like this where investment committees have found that they didn't have appropriate risk management in place. They didn't have a very dynamic decision-making process. They couldn't take advantage of tactical opportunities as they presented themselves in the market. So again, that's an industry that's already, or a trend that's already been in place in our industry that I think will only accelerate from here.
Okay. All right. Thank you so much. Thank you to all of our attendees for joining. Thank you to our panelists for all of that insight. Please feel free to reach out to any of us, especially Stacy, Eric, and Dave. Thank you so much for your time. And if you have any questions, please feel to reach out. Thank you for your time, everyone.
Thank you.
Yep. Bye, folks.
Thank you, Dean. Thanks, everybody.
Thank you, everyone.